Welcome to the Candlestick Forum Dark Cloud Signal Training Program. My name is Stephen Bigelow. I've been investing for over 35 years and over 25 years with using candlestick analysis. I discovered in the candlestick universe there's about 50 or 60 signals that are pertinent for showing reversals in price trends. However, out of those 50 or 60 signals, there are only 12 signals that you really need to learn. Those are what we consider the 12 major signals. The 12 major signals occur often enough and powerful enough that you do not need to know or learn the other 50 or 60 signals. However, it is good practice to go back through the reference books and familiarize yourself with the other signals. They do occur occasionally, but the information built into the 12 major signals are what's going to create probably 99.99% of all the trades that you'll ever do once you learn how to use candlestick signals correctly. Today's training will describe how to use the dark cloud cover with as effective reversal signals for your trading. The dark cloud was named by the Japanese rice traders because it looks like a dark cloud after a strong uptrend. The bulls are happy, the bulls are happy, the bulls are happy. Then all of a sudden you see a dark cloud. That tells you that you're now probably at the end of your uptrend. The effectiveness of candlestick analysis is adding all the other indicators or implications that tell you that you're getting near the top of a trend. For example, a gap up in an overbought condition usually represents exhaustion at the top. The signal itself on a dark cloud is a gap up above any of the trading of the previous day's candle. Now that is a little bit different than your bearish engulfing signal. The bearish engulfing signal does not have to gap up above any of the trading. It just has to open higher than the previous day's close. The dark cloud trades above any of the trading. Now also note that this last candle, the white candle, was a little gap up in an overbought condition. One simple rule in candlestick analysis: if you see a gap up in an overbought condition, start watching for a candlestick sell signal. A strong uptrend, major resistance level, which is where a good time or good opportunity to start watching for where other people are going to start taking profits. Candlestick analysis allows that opportunity or that visual capability by a graphic depiction of where the sellers are starting. Two basic rules of a dark cloud: it gaps above any of the previous day's trading, and secondly, it closes more than halfway down the last white candle. That is a very critical stage for analysis in Japanese candlestick analysis. The Japanese rice traders were very specific to say that if the bears were in control, they are now closing more than halfway down the last candle that told you the bulls were still in control. That halfway point is a very strong indication there's been a reversal. Another simple criteria for the confirmation of a reversal is a dark cloud signal, and then watch to see how it opens the next day. Obviously, if this is the beginning of selling, we want to see continued selling the next day. Notice they gapped it down a little bit and brought it back up, but the fact that they opened it lower told you the sellers are now starting to come into this trade. Obviously, you want to see a candlestick sell signal occurring in the overbought condition. In candlestick analysis, seeing a candlestick sell signal in the oversold condition doesn't mean very much. Seeing a candlestick sell signal in an overbought condition has much more meaning and credibility that there's going to be change of investor sentiment. A dark cloud or any other candlestick sell signal is going to be working more effectively if the stochastics are in a downward direction. We should probably step back if you haven't seen the criteria on other charts. The stochastics are in the overbought condition if they're above 80. They're in the oversold condition if they're below 20. On our charts, we usually have the blue line as a 50-day moving average, the gray line as the 20-day moving average, and the thick red line, which are on the other charts, is the 200-day simple moving average. These moving averages are on our chart because the capabilities of candlestick analysis shows graphically what is going on in investor sentiment, especially at important technical levels. All the major money managers around the world use the simple 200, 50, and 20-day moving averages to make major decisions about their portfolio. The advantage that we have with candlestick signals is that we can see exactly what's going on at those levels. Also, you'll note the black line is our T-line. Very important. You're going to see this quite often on our charts. The T-line is the 8 exponential moving average. Very simple rule. If you see a candlestick sell signal and a close below the T-line, the probability is you're going to be in a downtrend until you see a candlestick buy signal and a close above the T-line. Very critical. A gap up in an overbought condition and selling makes the effectiveness of a dark cloud due to the fact that it closes more than halfway down this last bullish candle. This is the dark cloud that changes the happy uptrend, that now there's a dark cloud at the top of that trend. Now we're looking for selling to continue and closing below the T-line. This is usually the beginning of a very strong downtrend. The magnitude of the strength of a signal is usually created by how far they open it above the previous day's trading or how far below they are trading into the halfway point or below of the previous candle. The bigger this move to the downside and to the lower end of the trading range, the higher the probability there's been a change of investor sentiment. That gap up in the overbought condition usually represents exhaustion. Now here's one of the stop loss procedures that we use that make using candlesticks very effective. When is it time to sell? A lot of people have the fear of selling because, boy, what would happen if I sold and it continued to go right up? That creates the problem of holding onto a position way too long until you decide you can't, you gave up too much of your profits and then you sell out. Candlestick analysis has the benefit of very simple rules that the Japanese rice traders have illustrated for us. Where do most people buy? They buy exuberantly at the top. So you take that information and use it to your advantage. Very simple stop loss procedures. If it gaps up and starts trading higher, put your stop loss at the previous day's low or open. I'm sorry, at that day's open. The rationale band, if it gaps up and moves up, something good's happening. If it gaps up, moves up and pulls back, that's probably exhaustion. So you want to stop out one tick below where it opened. On the other hand, if it gaps up and immediately starts selling off, put your stop at the previous day's close. Rationale being, if it comes back down through that level, it's going to form some sort of candlestick sell signal that day. So the nice thing about candlestick signals is they have information built into each signal. Dojis represent indecision. Dark cloud represents a change of investor sentiment. So in this case, when we start seeing dojis in the overbought condition, start watching for selling. It may not be immediate, but the whole syndrome up here, the whole community of selling signals tell you there's probably a change of investor sentiment coming. The dark cloud is finally confirmed with a lower open the next day, and then finally closing below the T-line. Here's another case to demonstrate a dark cloud is also a shooting star. It opens, trades up, put your stop one tick below the where it opened. It comes back down and closes more than halfway down this candle. You've got a shooting star / dark cloud. It doesn't matter what you name it, just as long as you can see that the illustration is that this is the time where the investors are starting to, or the bulls and the bears are starting to change their trend or change investor sentiment. Again, the important factor is they close this more than halfway down this last candle. As with all candlestick signals, the bigger the signal, the higher the probability there's been a change of investor sentiment moving the other direction. Another case for watching for that little gap up and then seeing it close more than halfway down this candle and a close below the T-line. All elements that there's been a change of investor sentiment, you want to start shorting this stock on any confirmation that it's trading lower after that signal. The visual aspects of candlestick signals allow an investor to see what's going on in investor sentiment with much more clarity. This was not a signal, but they opened it higher, traded it up, and closed it lower. The next day they were still trading higher. This was still not a signal. This was just a down day in an uptrend. However, it was when we actually saw this signal, the dark cloud behind some selling, started giving you full confirmation that the bears might be starting to take control. One of the important aspects about learning what signals reveal versus a non-signal is that if this was an important sell signal right here, over 400 years the Japanese rice traders would have come up with some sort of name for it and told what the results would be. Notice that this one opened lower and closed below the previous day. That's a big down day, which would be an indication of selling. However, it's not a reversal signal. Otherwise, we'd have a name for that. It is not until they gap it up and close it more than halfway down and create a dark cloud that this uptrend is finally over. The further they gap up the price on the open and start reversing it, the higher the probability that that was the exuberant buying at the top and the bears were taking control. Also, other visual capabilities are to see where that reversal is occurring. Notice that this occurred right here at the 50-day moving average, one of probably the potential large resistance levels. Or the fact that the reversal has been a big signal after a big day to the upside, then a big day back down again, gives you a clear impression there's now a definite change of investor sentiment, especially over the next couple of days if they can close it back below the T-line. Notice how the T-line works effectively for keeping you into a trade until you see a candlestick buy signal and a close above the T-line. However, there's one caveat to the T-line. The further you move away from the T-line, the higher the probability you're going to move back up to it. The dark cloud has very simple rules. The further it gaps up in an overbought condition, get ready to start placing your stops. The bigger this signal is, the higher the probability there's a reversal, especially the further they close it down below the halfway point of the previous candle. Third or fourth, right here at a major resistance level, is another obvious spot where the major money managers around the world are now making their decisions of whether they should be owning or selling this stock. One of the great benefits of candlestick analysis is to see what is going on exactly at support and resistance levels. The dark cloud provides a lot of information at a resistance level. This becomes a case of observing the obvious. If it moves from one moving average, where do we expect it to go to? The next moving average. That's where most people are going to start making decisions of whether they're going to stay in or get out. The fact that they gapped it up above the 200-day moving average would have looked very bullish until they closed it back below the 200 and formed a dark cloud. That should have immediately given the candlestick investor information to say they aren't going up through the 200 right now. Take your profits and wait for another buy signal. Also be aware that a lot of times they will gap it up and open right at a resistance level. That's where you want to start immediately watching to see whether they're going positive to break out or whether they fail at that level. Taking profits as the stochastics are in the overbought area and they've extended up to a resistance level, always prudent to take about half your position off, take profits. The other half you take off if you see it come back down through the previous day's close. If it closes at a dark candle, what are we looking for the next day? After a failure of the 200, if they can close it below the T-line, that tells you you're in a downtrend. The more pieces of information that you can utilize to show there's a resistance level, such as a moving average. Notice the gap up right at the moving average and pulls back, dark cloud. Also, it peaked out right at the same level it peaked out before. So if you can pretty much assess that this was the top, took it back up, hit the top again, and a resistance level, and a candlestick sell signal, that just improves the probabilities that they're not going to go through or continue the uptrend, that you're now starting a downtrend. Keep in mind, the more pronounced this signal is, the more compelling that you're going to be in a downtrend. This is the benefit of candlestick analysis, is the graphic depiction of investor sentiment, which now can be seen very clearly on a chart basis, gives the candlestick investor the advantage to see what's actually going on in investor sentiment well before other chart systems identify that same change. As with all candlestick signals, once a signal is formed, it's good to see confirmation. A confirmation is usually on a sell signal, a lower open. And the further they open it lower, the more compelling it is that the sellers have taken control. Here we've got confirmation after they do a dark cloud in the overbought condition. They open it lower, which would have been your sell signal, and they close it below the T-line by the end of the day, which was further confirmation for your sell signal. You should have been out here, and now you can consider going short because you're below the T-line. Dark cloud closes right near the T-line. This is a benefit too. If you have a candlestick signal that closes right on the T-line, it becomes a double confirmation. If they open it lower, that's one confirmation, and they're opening it lower below the T-line, which immediately tells you the T-line is not going to act as support anymore. Get out of the position if you haven't closed it on the signal, and go short. Adding all the criteria together, a gap up, a big candlestick reversal signal, and a gap down on the T-line with further confirmation to the downside, the more information you can put into your analysis, the higher the probability the trade's going to be going in the direction of the signal indication. Logic tells us that if you're in an uptrend and they gap it up near the high end or above the previous day's trading, something good should be happening. Something's starting to really move this price. The fact that they immediately start moving it back should tell you to start watching for that candlestick sell signal. There's often times where they'll bring it back and then take it right back up again, doing a hanging man, which is another one of our trainings. But if they have closed it down here, that tells you exactly what you want to know, that this is where the sellers are starting to take control. You want to be out of the position. Next day they open it lower. Even though they took it up, the trend should be down. This was the indication the sellers were taking control. Again, if you see that gap up and the price trading right around what can be obviously considered a resistance level, watch to see what it does. There should be two things that will happen at this level. They're either going to go through or they're going to fail. The fact that we start seeing it come back down through the previous day's high after not getting up above this level should be a sell factor. And the fact that they closed it more than halfway down this candle is confirmation that the 200 is now going to act as resistance. It's time to be out of this trade. Could it bounce off the 50 or the T-line and head back up? Yes, but why go against the probabilities? The probabilities right now are telling you that they're heading lower. This is what you want to keep from being in this big gap down once they have failed a resistance level. And a failure of a major moving average doesn't have to be right at that level. It just has to be near that level, because that's, again, near this level is where everybody's going to be making their buy or sell decisions. At this point, if they were going higher, we wouldn't be coming back to the 200. Even though they just slightly opened it above this level, they brought it down to about the halfway point of this candle. That's telling you they weren't going in this direction. Understanding the different signals and patterns in candlestick analysis helps evaluate what are the stronger reversal signals. For example, when they gap it up extremely high and bring it back into the trading range, we've got a belt hold signal as well as a dark cloud. What's the significance of that big gap up and then selling it off? It tells us a lot of buyers were wiped out. The sellers were taking control. The bigger this signal, the higher the probability we're now in a downtrend. This is a perfect example of where the exuberance is shown up on a chart. Again, when they gap it way up here and start selling it off, put your sell stop at the previous day's close. If it comes back down through that level, that tells you the bears are definitely in control. Now you've got the opportunity of either have a meeting line, a dark cloud, or even a bearish engulfing signal. Adding the evaluation of a belt hold just creates that much more expectancy of a high probability situation. That belt hold signal, without it even being a dark cloud, creates a high probability that they're going to be in a downtrend. The fact that it's also a dark cloud gives it that much more credibility that the sellers are in control. Now you can start adding other factors. Next day there wasn't too much buying. The next day they gapped it down below the T-line. Stochastics heading down. These are all indications that the sellers are winning. The uptrend is over. The appearance of a dark cloud basically tells you that that was the end of that uptrend. The selling, although it doesn't come out of the range of the uptrend, is a foretelling that the bears are in control. There's going to be other technical indicators or technical methods, trading methods, showing that you're still in an uptrend as long as you don't break out of this trading range. The fact that we can see what's actually going on in investor sentiment because of a signal allows us to be much more prepared for selling well ahead of other technical trading groups. Once again, the uptrend reversal can be seen by adding the elements together. A little slight gap up, stochastics rolling over, a close more than halfway down this last candle, and a close right basically on the T-line. What's that give us as far as an opportunity to go short? The mere fact that if they open it lower, they're confirming the dark cloud and they're confirming that the T-line is not going to act as support anymore, that starts your downtrend. As many factors as we can put into place to tell us that the trend is over and going short, the higher the probability we're going to be in a correct trade at the correct time. That evidence is even more so if you've got a major resistance level or a technical level that everybody else is watching, like the 200-day moving average. What are we looking for? Bearish or dark cloud, a lower open the next day, but it did a doji day right here on the 200. Now this makes it very simple. If they're in an uptrend, they're going to move it in the direction of how they open it after a doji. If they're in a downtrend, they're going to open it lower. If they're in an uptrend, that means the 200 was just acting as a support level, taking it back up. If they open it lower, we also have another candlestick pattern that's very high probability results. What we call the doji sandwich, where you have a big dark candle, a doji, and another big dark candle. This candle somewhat the same magnitude as this candle right here. Also, it allows you to get in at the appropriate time, already making a profit, starting a strong downtrend. So if you add up all the elements, a gap up in the overbought condition, a close back below the halfway point of this large candle occurring in the overbought condition, telling you the exuberance was starting to come into this trade, and the next day they open it lower, confirming the dark cloud, and continue to confirm by closing below the T-line. Add all those elements together, that creates a high probability trend evaluation. Dark cloud at the same level it topped out before, halfway down this candle, and open below the T-line, gapping down, causing a downtrend. We are reiterating, repeat a lot of these charts in these type of trainings because this is nothing more than visually learning what signals to look for and what the elements are that create a successful signal. The more you study charts, the more you're going to see at the tops and the bottoms some sort of candlestick reversal signal. Probably 90% of the time you're going to see a candlestick reversal signal. 10% maybe not. But that 90% of the time is what the Japanese rice traders have identified as being high probability reversal situations. Candlestick sell signals such as a dark cloud also eliminate or end the potential of a pattern such as a fry pan bottom setup, as we can see the slow curvature of the bottom of this trading range. Then a dark cloud followed by a gap down tells us this trajectory is gone. We're now in a downtrend. Investor sentiment is easy to interpret on a chart, candlestick chart. Dark cloud just touched the T-line. The bigger the gap down, the more compelling it is that this signal is being confirmed, and there's going to be further downside. This is where I often tell our members of our chat room, observe the obvious. The obvious is after a sell signal, they want to be out of this position. A candlestick signal doesn't necessarily mean that the downtrend is going to be immediate. Here we have a dark cloud signal. Good indication that the selling or the buying has stopped. However, do not close it below the T-line. A doji day, they take it back up. This would have had a lot of people still expecting some more upside. However, when they gap it down and close it below the T-line, you start adding all the indicators together. We had a dark cloud, still a pop-up from the uptrend, which is not unusual, left over from an uptrend. But when they do a sell signal, and a few days later they close it below the T-line, that's good evidence that now there's been a change of investor sentiment. The rule of the T-line is the further away you move away from the T-line, the higher the probability they're going to come back and test it. So if you do see a dark cloud and it's a good distance away from the T-line, and they open it lower, even though you haven't closed below the T-line, you might start taking profits with the anticipation that either they're going to take it back up and you can always buy it back in, or if you don't see anything that was really compelling to buy back in, at least you got out at the right time. There's nothing wrong with looking at a signal, having it confirmed, close out the position, and then buying back in if a new pattern has started. The pattern will reveal how severe the selling has become. A close almost down at the low end of the trading range tells you there's been a severe change of investor sentiment, to the point where a little bit further would have been a bearish engulfing signal. Also, a severe selling day, taking up most of the previous day's candle, and that close below the T-line just makes it more evident that if they open this lower tomorrow, the bears are definitely in control of this trend. The gap up in the overbought condition becomes the alert. The sell is they close below the halfway point. Is this starting to show weakness? Note that we had a bearish Harami a few days prior. So we're already starting to see some sell signals up here in the overbought condition. Now we're getting a confirmed sell signal. When they open it lower the next day, you can be out of the position and or shorting the position. Let's take a few minutes and review what the aspects are of a dark cloud signal that gives us a good probability that the uptrend is over and a downtrend is beginning. The appearance of a dark cloud is going to start telling you that the uptrend is over. Even though you have some more buying, this was kind of the signal to tell you that the bears had started to take control. Doji tells you any buying after that was indecisive. The gap down through the T-line tells you this is what's going to happen after this signal. A dark cloud followed by a lower open is pretty much evidence immediately that the sellers are starting to take control. So as soon as you see a dark cloud, start looking for evidence of that sell signal. It may be the next day with a lower open and starting to trade lower. The gap up is the first major alert. Tells you that the exuberant buying has come in. Easy to set up stops. It opens higher, trades higher, set your stop at where it opened. Opens and starts immediately selling off, set your stop at the close of the previous day. Both situations will definitely show that there's a candlestick sell signal in creation. Even though there might be a little bit of buying after the signal, it's usually an indication that there is a downtrend in progress. And like all candlestick signals, the bigger the signal, the more compelling there's been a change of investor sentiment. The nice thing about the visual aspects of candlestick signals is that we can see when there's been a major change of investor sentiment. Those signals get inordinately big compared to the rest of the trading in that previous uptrend. And if the gap up isn't extravagant, but it's forming right at a resistance level, the signal becomes compelling once it closes back below the halfway point. The further it closes below the halfway point, the more strength we're going to see in the downtrend. This is clearly evidence that when they took it up to test the 200, that we could see visually they weren't taking it through, they were knocking it right back down. Candlestick signals provide a huge advantage for the investor to see immediately what's going on at major resistance levels or support levels on the buy side. A dark cloud right at the 200-day moving average is immediate evidence they aren't taking it up, they're taking it back down. With stochastics starting to roll over, that's a further indication that the sellers are starting to take control. When they finally gap it down through the T-line, you know you can be shorting. The dark cloud is just a good signal to tell you it's time to be out of the trade. You can always come back in on another buy signal. But the probability is that you're expecting a downtrend from that level. No matter which way you're trading, once you see a sell signal, you should be at least expecting a downtrend. This is not from technical or computer-generated gobbledygook. This is from actual trading that the Japanese rice traders have experienced over 400 years. They didn't theoretically suggest these signals. They actually use these signals to the point where the Japanese rice traders that use this program didn't become wealthy. They became legendarily wealthy in the Japanese folklore. That will bring our training for dark cloud signal to an end. Remember, candlestick signals are high probability expected result situations. Please use that information to your advantage, and good trading.